Wall Street is bracing for a recession, and many analysts say that it's inevitable. So why do stocks keep climbing higher and higher? And more importantly, is it safe to buy right now? In this video, I'm going to share with you what stocks typically do before a recession, once a recession is announced, and after a recession is over, including a powerful signal that could tell you exactly when to start buying more. Plus, I'm going to reveal the surprising truth about when recessions actually begin, because guess what? By the time the media announces it, it may have already been the wrong time. Now, just 6 days ago, Jamie Dimon sits there and warns of economic conditions deteriorating soon. We have heard a lot of these forecasts coming out, and CEOs have their pulse out there because they're sitting there and seeing their orders come in. Warren Buffett famously talks about how he watches his shipping lines. He goes, listen, I look at how many cargo ships and containers are loaded up and unloaded every single day. When I see slowdowns there, it probably means that things are dissipating. Because remember, these are the indications, and it's fun to think about these. How are applications for loans going? How are loans being repaid? Are there delinquencies there? These are the kind of things you look at and say, okay, it's nice to observe these things. I actually like hearing this data just to understand it, but I don't let it mix into my brain about what is concerning me. Look at a company like Nike, a company I own, and their revenue is down over the last year. And a lot of people are scared about that. They say, look, revenue is down. Look, they're going to zero. Maybe. I doubt it. I look at it saying, okay, there are going to be temporary issues. Jamie Dimon might see an increase in delinquencies on car loans, boat loans, things like that. But does that mean that it's something to be fearful about for the rest of our lives or for decades to come? No. Guys, we had the world shut down in 2020. Literally, the world shut down. And guess what happened? We came back stronger. Now, guys, you've got to remember, recessions are not announced as they start, and they're not announced to be ended as they end. It's always after the fact. But along the way, we're fearful, we're scared. And as an economy and as a consumer and as businesses, we react to the news that's being explained at that given moment. Guys, look at my Excel sheet, very simple. Here are the 5 recessions since July 1981. Look at them. The 5 recessions since 1980. 3 were announced after they even ended. Started July of 81, ended November of 82. It was announced in January of 82. So yes, it was announced during the recession, but it was announced 7 months after it started. Here's something interesting. The next recession, July of 1990, ended March of 91. They made the announcement that it started on April 25th, 1991, and they announced the end of it on December 22nd, 92 for a gain of 16.1%. Can you imagine that, guys? It gets even better. March of 01 to November of 01, a loss of 8.2%. And the announcement dates, a loss of 15.18% between November of 01 to July of 03. Now, the great financial crisis started in December of 07, ended in June of 09 for a loss of almost 38%. This is Bernie Madoff time. Bernie Madoff was arrested 10 days after this. That's how late it was. And between the announcement start and end dates, a gain of 32.35%. And of course, COVID, well, when they shut down the world in March of 2020 on March 15th, we all realized something was going to happen in the economy. So it's a little bit different. We only had a loss of negative 9.71% because we saw a massive rebound in stocks from the COVID low very quickly up. And from the announcement dates, 31.74%, again, because the market just rebounded like crazy. Isn't that incredible? You know what's interesting, guys? During the time, stocks did terrible. So they announced it, and 4 out of the 5 times stocks went up from there after the announcement. Now, guys, people react. You look at the stock market during the great financial crisis, it peaked in October of 07. Guys, we hadn't had Bear Stearns yet. We hadn't had Lehman yet. But do you think that those things did not exist the year before when we hit peaks? Of course they existed. We just didn't really understand them. That's what we talk about here. It's not about sitting there and being negative. It's about sitting there saying, what is under the radar that people are ignoring? We currently believe it's valuations, and there will be a spark that causes the explosion. But as of right now, we're looking at it saying, when people are most fearful because the recession's been announced, that proves that that's the time you should be most aggressive. That's the time you should go against all your feelings and say, okay, everyone's scared about recession, therefore everyone is selling their stocks. If everyone is selling their stocks, stocks are falling. If these are great companies or the entire market, will I look at this in the future and think opportunity? Let me show you this chart. Guys, this is a logarithmic chart. What I mean by that is this value is 10, this value is 10,000. Clearly, it tries to even it out. But look at all of these recessions, recession, and these are all the bottom lows. Where are they at? They're in recessions. All these gray areas are recessions. These are your opportunities. Because if I told you right now you could only buy 15 times in history, guess where you would have bought? Pretty much every time you see an X here, in the middle of a recession. That's the freaking point. You cannot fear recessions. You've got to change that way of thinking. If that sounds counterintuitive, it should. It was counterintuitive to me. But remember, you're a long-term investor. You care about decades from now. So you want to look at back then like you're going to look at today. What am I going to look back on 30 or 40 years from now and say, man, I wish I put more money in? Is it during the best times when valuations were high, or was it during the worst times when everybody was afraid? The answer is very clear, and you know the answer without me telling you. Start investing aggressively. Start switching your fears when the announcement of the recession has started. Because once the announcement's made, people start to get scared. This is all part of our way of thinking. We have a principle-driven approach to investing. We're investors, not speculators. Thinking this way is important. That's our very first tenet. We buy because we understand what the history has shown and what the future can show because of that history. 2, every investment, no matter what you're making, is the present value of all future cash flows. So the more you pay, the less return you make. So you should want to have lower prices because it means more return. If we don't understand it, we don't buy it. That's the third tenet. It's very simple. If you don't understand how you can make money, you're not going to understand how you will lose money. And that's really, really important. 4th one, in the short run, stocks are a voting machine. In the long run, they are a weighing machine. In that short run, that fear of recession, that high unemployment, that's going to get people to sell their stocks and make stocks fall. That's the voting machine. In the short run, when things are euphoric and great, it's going to make stocks rise. But that's not the way we are. We sit there and look at the long run. Are you paying a reasonable price today for the investments you're making that'll give you a good return on your money? And the 5th and most important one, and it's the most important to hear right now, a great story can become a bad investment if you pay the wrong price. And a bad story is a good investment if you pay the right price. All these X's here were bad stories. Every single X here was a bad story. But guess what? The price was correct. We over-exaggerate the good, we over-exaggerate the bad. That's so important. Guys, that principle-driven investing has absolutely changed the way in which I think about money. I think about these tenets every single day. If you want to get a more thorough description of all 5 of these tenets of principle-driven investing, click the link below. We will email you a copy of this immediately. It's absolutely imperative that you have this at your access. That way you can repeat these things in your head. So click it right now. You will have that PDF within minutes, and it's absolutely free. Guys, I don't want you to care about the economic noise. I don't want you to care about recessions. I was at a birthday party this weekend, and my brother's brother-in-law said to me, hey, Paul, so what do you think about, are we in a recession or are we not in a recession? I just said, I don't care. In fact, I did the whole Jay Cutler, don't care. I could not care less. Now, and honestly, I do hope we have a recession. I want to see stocks fall. We have been at overvalued levels that are just nosebleed. It is becoming difficult to find great companies at great prices. It doesn't mean you should be jumping in and out of investments. I always hear on CNBC or I see on Market Watch or Barron's, oh, the trade right now is you got to get out of this and go into this, No, just buy great companies at great prices and let them compound. Do not interrupt it unnecessarily, as Charlie Munger would say. Buy low-cost ETFs and bet on the U.S. economy being better 10, 20, 30, 40 years from now. Do we have issues? Yes, we do. But the funny part to me is the one issue people should be worried about, valuations, is the one they don't care about. And they justify away. Oh, no, it's different now. You can have higher values. And you've been saying this for years, Paul. And yeah, I have been saying it for years. And we've been overvalued for a very long time, to the tune of over 100% overvalued based on history. But we don't worry about that. What we're more worried about is how somebody might lose a job here. 2 out of every 100 people might lose their job for an extended period of time. That's not to be made to say that it doesn't matter. It does matter, especially to the person that loses their job. But that's why we're here to teach on this channel. Live within your means, save properly. If you feel better having an emergency fund, go ahead and do it. I don't believe in them. I think it sacrifices too much from your future. But Jamie Dimon here, he's a smart guy. When I see him say things like this, I go, okay, well, he's seeing something in the data that might be interesting. Does that mean he's changing how JP Morgan runs? Of course not. He might sit there and be a little more cautious, put some more reserves in for loan losses, but their business is still going to be the same. Why shouldn't your life be the same way? Stop making reactions to all this fear out there. You got to stay focused on the fundamentals in order to make sure that you stick with the fourth tenet. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. The fundamentals will drive the value of the stock in the future. Peter Lynch always says that a stock price is 100% correlated with the performance and the underlying metrics of the business. That also assumes you pay the right price, because we have countless examples from the early 2000s where companies are much bigger now than they were back then, yet the stock has not gone over those maximum prices from 2000 because the price and value were mismatched. This is where price and value are going to be mismatched to your benefit. This is where price is going to be here, but value is going to be here. That's what you want. I personally believe that today, price is here and value is here. That is not a good recipe for good returns. So guys, as I said, the real fuel behind the next market collapse is something far more dangerous, the valuations. Remember, as John Hussman says, in a room filled with gasoline with a fire in the corner, we don't know which spark will cause the explosion, but there will be a spark that causes the explosion. In my opinion, the room filled with gasoline is our valuation problem. Click the video on your screen right now. We're going to show you just how extreme valuations have become, reaching levels we haven't seen in almost 100 years, and why it could possibly derail your whole financial future if you are not prepared emotionally. Thank you for your time.